Are you ever sitting at your kitchen table looking at that mortgage statement and thinking, I wish this thing would just go away? Maybe you dream of the day when your monthly payment disappears and all that cash flow is freed up for travel, giving, or just breathing easier. But at the same time, maybe you've also wondered, if I send extra principal payments every month, am I locking away money that I might actually need someday? Well, you are not alone. This is one of the most common questions I get as a financial planner. Homeowners want to be debt free, but they do not want to put themselves in a financial pinch to get there. So, in today's video, we're going to talk about a really smart and flexible way to pay off your mortgage early without sacrificing your safety net, flexibility, or financial stability. This strategy involves building a side fund, maybe a money market account, or maybe a brokerage account, while continuing to make your regular mortgage payments. Then, once that side fund grows large enough, you make one big lump sum payment to wipe out the mortgage. By the end of this video, you will understand why a side fund often outperforms sending extra payments directly to the bank, the biggest risks and how to manage them, the step-by-step method for determining how much to save and when to make the payoff, and how to customize the strategy to your own financial plan. So if you want the peace of mind of owning your home free and clear, but you also want financial flexibility, this video is definitely for you. Let's jump in. I have to start by acknowledging something a lot of people feel but rarely say out loud. Carrying a mortgage is emotionally exhausting. For many families, that monthly payment is the largest bill in the household. And even if you can easily afford it, there is still this sense of vulnerability that comes from having a lender who expects that payment every single month, on time, without exception. So, naturally, people try to get rid of it faster. But the traditional method for paying off a mortgage early has problems. This method is simply sending extra principal payments every month or every year. This is simple, but once that money goes to the mortgage company, it is gone for good. You cannot get it back. Let me say that again because it's so important. Once your extra payments go to the mortgage company, the money is no longer yours. So, the strategy we are covering today, the side fund mortgage payoff strategy, solves this problem. Here's the basic idea. You continue making your regular mortgage payment. Then, instead of paying extra principal to the lender, you put those extra dollars in a separate account. Over time, the account grows. And when that balance equals your remaining mortgage, you pay it off in one shot. You maintain full control of your cash, you maintain your emergency reserves, and you still arrive at a mortgage-free life. That is the big picture idea. Now let's dig into the details. Let's imagine you have a 30-year mortgage. Maybe you have 25 years left. You want it gone sooner, but you also want a healthy financial buffer. So here's the question. What if instead of sending $200, $500, or even $1,000 extra to the bank each month, you save those dollars in an account that you own and control? That account becomes your side fund. Now, there are two common places to hold your side fund. Number one, a high-yield money market fund or savings account. Number two, a taxable brokerage account invested in a diversified portfolio. Each one has different pros and cons. Option one, a money market side fund, no volatility, lower growth. And this money market fund is stable, predictable, and very low risk. It's a great choice if you want certainty and want to minimize downside risk. You will earn a modest return, maybe somewhere around 3 to 5%, depending on the current interest rate environment, and your balance will not fluctuate. The trade-off? It will take longer to accumulate enough to pay off the mortgage because the growth rate is lower. But safety is high, and there is almost zero chance your balance will be down when you need it. Now, option 2 is a brokerage side fund, which has higher volatility but higher growth potential. So a brokerage account gives you access to stock and bond market investing. Your potential long-term average return might be higher, maybe to 7 to 10% over decades, but the ride will be bumpy. This is the big risk. If the market is down when you decide you want to pay off the mortgage, you may have to wait longer. So why do people choose this? Well, because your money has the potential to grow faster, meaning you might be able to pay off the mortgage years earlier than with extra payments or a money market side fund. So why not just make extra payments? Well, you might be thinking, Josh, this sounds okay, but why not just send extra principal directly to the lender and pay the mortgage down faster? Good question. And here's the honest answer. Because extra payments benefit the mortgage company far more than they benefit you. When you send extra principal early in the loan, you reduce the future interest the lender collects. That sounds good for you, but remember, you lose access to that money forever. It becomes home equity, a wonderful thing, but not liquid. So if a big emergency hits and you need cash, the mortgage company is not going to say, hey, you've been such a loyal customer and made all these extra payments. Why don't you skip a few months while you get things sorted out? Nope. They will charge late fees. They may report you as delinquent. They may even start foreclosure proceedings if things get bad enough. Let me put it bluntly. Your mortgage company does not love you. They don't care about the extra payments you have made in the past. They care about the payment that is due right now. This is why liquidity matters. A side fund keeps your options open. It gives you control. If a major emergency hits, you can pause contributions to the fund or even use the fund to bridge your cash needs. You cannot do that with extra payments sent to the lender. Let's walk through the 3 biggest advantages of this strategy. Benefit 1, you stay liquid. This is the biggest one. Liquidity is your financial oxygen. When you run out, everything becomes a crisis. By saving into a side fund instead of paying extra principal, you keep your money accessible and flexible. If your job changes, your income drops, or an unexpected medical bill happens, you still have cash available. Many people accidentally make themselves house rich, cash poor because they have shoved every spare dollar into their home. That's not financial security. That's financial fragility wrapped in a warm, fuzzy feeling. A side fund keeps you liquid. Benefit 2, you gain psychological control while still moving towards freedom. Many people want their mortgage paid off early because they crave the feeling of freedom, but they also want the confidence of knowing they can handle life's curveballs. The side fund strategy lets you experience both. You make visible progress toward eliminating the mortgage. You can watch your side fund grow each month. You maintain control over the timeline. It is motivating, it is encouraging, and it is far less stressful than draining your cash to send money to the lender. Benefit 3, you get potentially higher returns. Now, this one's optional, but powerful. A brokerage, a side fund, gives you the opportunity for long-term market growth. And because your mortgage interest rate might be 4%, 5%, or 6%, you may earn more in the market than you save in interest. Now, this is not guaranteed. Market volatility is real, but historically, long-term diversified portfolios have produced higher returns than typical mortgage rates. So, if you have a long runway and a high volatility tolerance, a brokerage side fund may accelerate your payoff. No financial strategy is perfect, so let's talk about the risks. Risk one, market volatility, if you use a brokerage account, of course. The largest risk is obvious. If the market drops right when you are ready to pay off the mortgage, you may need to wait longer to make that final payment. This does not mean your plan failed. It simply means your timeline shifts. If you want to reduce this risk, you can glide down your portfolio over time. Maybe in the final 3 to 5 years before payoff, you gradually shift some investments into money market funds. This smooths the ride and reduces the chance of a big downturn derailing your plan. Risk two, spending the side fund instead of staying committed. Now, this is a behavioral risk. Some people see a growing pile of money and start imagining other uses for it: vacations, cars, gadgets, home renovations. That temptation is real. The best way to protect yourself is to treat the side fund like a mortgage payoff account, not like extra cash. Make it separate, make it intentional, make it boring. You can even nickname the account something meaningful like Mortgage Freedom Fund. Risk three, the mortgage lender still owns the timeline until the lump sum. Because you're not actually reducing your mortgage balance until the big payoff date, you will continue paying the scheduled interest in the meantime. Some people struggle with this emotionally because they want to see the loan balance go down faster. But remember, the interest you pay is the cost of maintaining liquidity and flexibility. And that flexibility can save your financial life in a major emergency. Let's break this down so you can follow it in your own financial plan. Step one, build a real emergency fund first. Before you ever start a side fund, you need a real emergency fund, typically 3 to 6 months of living expenses. This is your first line of defense. The side fund comes after your basic emergency fund is solid. Step two, calculate how much extra you want to save each month. Look at your cash flow, decide how much you comfortably want to allocate toward the future mortgage payoff. It might be $100 per month. It might be $500. It might be more. The key word is comfortably. Once you pick a number, automate it. Step three, choose your side fund type. Do you want a money market account with no volatility and low growth, or a brokerage account with more growth potential and more volatility? There's no universal right answer. It depends on your volatility tolerance, time horizon, and financial personality. Step four, automate deposits. Automation is everything. Make sure your monthly side fund deposit happens automatically, just like your mortgage payment happens automatically. The fewer decisions you need to make, the better your long-term results will be. Step five, track your mortgage balance and your side fund balance. Every 3 months, just check in. How much is left on the mortgage? How much is in your side fund? This is your scoreboard. It helps you see progress and stay motivated. And step six, decide when to make the payoff. Eventually, the side fund balance will equal your remaining mortgage balance. That is your green light moment. Call the mortgage company to get the payoff amount. This will be the best call you have ever made to a mortgage company. Finally, step seven, celebrate and redirect your cash flow. Once the payoff is complete, take a moment to soak in the accomplishment. Celebrate with your family that you no longer have a mortgage. You now have an extra $1,000 or more per month of cash flow available. And this is where the magic happens. Redirect that cash flow towards your next priority: financial freedom, college savings, or other financial independence goals. Paying off the mortgage early is not the finish line. It is a massive win and a launching pad to the next level of financial freedom. Let's walk through a simple example. So imagine you have a mortgage with $200,000 remaining. You decide you want it gone in 10 years instead of 25. So you run the numbers and decide to save $800 per month in a side fund. You choose a money market fund earning 4% interest. After 10 years, your side fund grows to roughly $118,000. That is not enough to pay off the mortgage yet, but your regular monthly mortgage payments have also reduced the balance during those 10 years. So instead of still owing $200,000, maybe your mortgage balance is now around $115,000. You see what just happened? Your side fund now equals the remaining mortgage. You are ready to pay it off. No stress, low risk, plenty of liquidity the entire time. If you had chosen to invest in a brokerage account, maybe your side fund might have grown faster or slower, depending on the markets. You would simply adjust the timeline accordingly. Now, let me cover 3 common mistakes I see people make with this strategy. Mistake 1, neglecting the emergency fund. Your emergency fund is not optional. If you skip it, the side fund becomes a tempting but dangerous substitute. You need a true emergency fund before you ever begin this strategy. Mistake 2, investing too aggressively too late in the timeline. If you use a brokerage side fund, remember to gradually reduce risk as you get closer to payoff. You do not want a sudden market drop in year 9 to set you back another 3 years. A glide path solves this. Now, mistake 3 is not automating the savings. If you rely on manual monthly transfers, it will not happen consistently. Automation is what turns good intentions into real progress. Now, as we wrap up, let's do a quick recap of the most important ideas from today. First, paying off your mortgage early is about more than math. It's about peace of mind, flexibility, and long-term financial freedom. Second, a side fund gives you a smart and flexible way to eliminate your mortgage without sacrificing liquidity. You stay in control of your cash until the day you decide to make that final payoff. Third, you have options for your side fund. A money market fund offers low risk and steady growth. A brokerage account offers higher potential growth, but comes with the risk of market fluctuations. Fourth, the biggest advantage of this strategy is that you maintain access to your money. If life throws a curveball, you are not stuck with a lender who does not care about your past loyalty or extra payments. And finally, once the mortgage is gone, you free up an enormous amount of cash flow that can accelerate the rest of your financial goals. So I hope you found this video helpful and can use this strategy to achieve financial freedom. I'm Josh Duncan, partner at F5 Financial Planning. If you would like to learn more about how we help our clients achieve financial freedom for personal significance, please visit our website at www.f5fp.com. Thanks for watching, and I'll see you in the next video.